Okay, welcome everyone. I'm Gerrod Galliano here with Ashley Terrell. We're hosting Coffee Chat for you today. We are talking about Treasury yields, how they affect the market, and some of the recent news with the yield curve remaining inverted. How's it affecting things? Why is the market so wonky? Ashley, shed some light on us. Tell us what's going on with Treasury notes right now.
Well, as we know, the 10-year has just reached a 14-year peak. So highest it's been in 14 years. The 2-year yield is still higher than that. So like he said, it is inverted. It should be upward sloping. So eventually we should see it look more upward sloping. So either the 2-year is going to drop or the 10-year is going to increase more. So what do you think is going to happen?
Well, this is the question of the day for viewers, I think, is what's going to happen with markets and why is this such a big time effect on markets? And so we were just talking about this before we started. The idea of a treasury note is, one, it's backed by the U.S. government, so it's considered safer than, let's say, a stock, which a company can go out of business. Hopefully the government doesn't go out of business. But it's considered safer, so it's a sure bet. And with the current rates up to what, for 3, 6, 9, the short-term stuff, the 1 year and under stuff, you're getting 4.5, give or take, a little more, a little less. Not bad. That's 4.5%.
At this point, they're competing with stocks. So
yeah,
a lot of investors we can probably see choosing stocks less and starting to go towards that security, that fixed income. And there's a huge supply in treasuries right now. So what's going on with that? Why is there a huge supply in treasury yields right now?
Well, they're raising capital. So there's more available because they're raising more capital. It's going to create, more long-term loans, which is money they'll owe back to the purchasers. But once again, you're creating more opportunities for money to leave the market, which is the big fear, which is why we're seeing these big pivots. Why buy a bond, which is through a company that could go out of business? Like, you can go buy whatever company, reputable, but there's still the risk that they go out of business and you might get 6%. Is it worth that risk when the treasury yields are getting closer to 5? The 20-year is at 5, I believe, and the 30-year is almost there too. So it's like, man, why take the risk? Why roll the dice? And historically, stocks still outpace them for the long term. So for me and you, we could still.
I think that's the most important thing to consider is your time horizon.
Exactly.
So if you have a short term or a short time horizon, then you definitely want to be leaning in more towards the fixed income and those treasury yields.
Absolutely. And that's why this is also important for someone like Ashley's age, my age, even though I'm a little older. We can still say we have the 15, 20, 30-year horizon before we expect to, say, pull some of the money from our savings. So while the notes are becoming more attractive to someone like us, we can still say, yeah, this is some pretty rough looking times for the market, but we should have confidence that they'll outpace it by quite a bit. But if you're looking to retire in the next 3, 4, 5, 6 years and you're looking at pulling the money in less than 10 and you can get a guaranteed 5 or 4, that's starting to get tough to pass up for some of the money, right?
If you need your assets to generate income for you, then those treasury yields are the way to go. But like you said earlier, if you're closer to our age, then stocks are on sale right now. And it's a really good time to take advantage of that and get stocks closer to the prices that you would have maybe a year ago. So there's definitely opportunity in the market, just depending on where you are and what your needs are in the moment.
Let's talk about this. You have, just like I do, lots of new clients that come in and they say, I'm trying to generate income. Everybody's different. Everybody has different income needs, different expenses. But talking about the treasury notes, is there a certain type of account that they make more sense in? like the account structure versus another type, due to their taxation?
Yeah, it's probably a better idea. Depending, again, it's your each individual situation. But if you get those types of securities in an IRA where it's taxed whenever you take income, then that interest is not, directly taxable in that moment. If you have an account that's an after-tax account, then obviously that interest will be taxable as income. So it just depends on your situation. Are you looking to limit your income for tax reasons, or are you in retirement and have low income and that's not a priority of yours? So it just really depends on your individual situation.
Absolutely. And what's neat about the treasuries is you go back 3 years or maybe, I don't know, 3 or 4 years, they just didn't really exist as a viable option for producing income. So things have changed. The landscape in our world, as someone who builds out these plans, has changed dramatically, where we used to have to go to high risk, maybe dividend paying stocks, maybe not high risk in the world of the stocks, like they might be less risky than the average stock, but they're more risky than a CD or a treasury. So you're taking all this risk to get that 4 or 5%, where now it's just available. So our world has gotten more tricky when it comes to the stocks because it's such a volatile environment. But it's gotten easier when it comes to maybe the safe portion.
Right. And a lot of that has to do with the feds, the economy, and what the feds are doing is working. This is essentially what they want right now. This is what they want to see. They want to see, I guess, a little bit of a struggle before they commit to not raising rates any further. But in addition to that, we're running on a deficit. In June, the Congress just raised the debt ceiling. So we were really close to using all of our cash reserves, and we need cash. So obviously, the government's going to pay for it. So that's affecting rates right now as well.
What about people that are, most people are taking advantage of this kind of stuff that we see, maybe not treasuries, but they're taking advantage of CDs and similar vehicles that are having similar, rates because of the high borrowing rate. So what about people that are starting to think, what if they stop raising rates? What if this is around the peak of that in terms of the fight against inflation? What can those people do to kind of, we call it interest rate risk. You keep buying short term, one day that's the best rate you got ever, and that rate's gone. So what can you do to maybe get some of that rate for a longer duration right now?
I mean, here lately, I've been seeing some decent CDs that have terms of 18 months, which I think it's a pretty good length of time, that are paying 5.6, 5.7. So that would probably be a safe bet. That's something that I would look for in addition to the structured notes that we look at here. I think that that's a good alternative.
So you're starting to go out a little longer duration. Because we like to go in terms of 3 months, where you have some money maturing every 3 months. That way, if something comes up, a new opportunity comes, and you're making about the same interest for the 3 months. But then if you have the fear of the rates dropping off, and the Fed says, let's say in January, we're actually going to pause hikes this whole year, which I don't think they're going to say. But if they did, that would be like pretty big drop potentially. So we encourage folks to think about lengthening the duration a little bit right now, because we're getting to that point where, is it going to go up anymore? Maybe it just did. Like the rates didn't get hiked, but they actually creeped up a little bit.
For the most part, we're getting close to that peak. We assume, and it's a good time to reevaluate your portfolio and make sure that you're prepared for what is to come.
Yeah, and we encourage guys, bring it on in. There's nothing like looking at what you have under the hood of the car. You have an idea of what's the allocation of your investments. Bring in the statement. We can make sure you're taking advantage of some of these, historically high yields, where we can say, look, the stock portion, tricky as ever, but maybe we can simplify your life, get you a nice little stable return on the safe money, on that income stream that you want. So, Gerrod Galliano.
Ashley Terrell. Give us a call here at Burns Wealth Advisors.